Now we're going to go a little bit more narrow national, but obviously the U.S. plays a hugely important role in the global economy and in terms of global economic leadership. So it's really my great pleasure to have the Undersecretary of Treasury for International Affairs, Jay Shambaugh, with us today. So why don't we just jump right in, Jay? Tell me what U.S. Treasury's international priorities are at this point.
Our international priorities for these meetings are just overarching?
Both.
Both. Okay. Well, that's a lot. I think, one big issue for us, not necessarily for the meetings, but has been for the last stretch of time, is trying to responsibly manage the relationship with China. I think that has been a big issue. We just got back, I think, almost exactly a week ago from the Secretary's trip to Beijing. And we actually this morning had the fourth installment of the economic and financial working groups between us and our Chinese counterparts held at Treasury. And so I think trying to make sure we have a channel to communicate clearly whether there are places we have space for cooperation, which I think there are many, and it's really important to be able to work on those, but then simultaneously to talk through areas where we disagree. I think managing that relationship responsibly has just been one big priority for us. We think it's arguably the most consequential bilateral economic relationship in the world. I have heard other countries say to me, the most important bilateral relationship for me is the bilateral relationship between you and China. And so, we understand that it is not just kind of what the American people expect from us, but it's what the world expects from us to manage this responsibly. And so that's a big part of what we're trying to do. I'd say another one, though, that is a big theme for these meetings and something important to us is how is the international financial system writ large meeting the needs of low-income and middle-income countries, but especially low-income countries? I think that's something that we really want to make sure, we have these amazing tools. We're sitting in one of them, right? The fund and the World Bank and all the MDBs, as well as other funds that we have out there. There are tools that exist. Are we marshaling these tools as effectively as we can to meet the needs of low-income countries? I think that's another big thing that we'll be pushing. I'd say at all times, though, I think Russia's war of aggression against Ukraine is something that looms large over the way U.S. policy is thinking. And so we'll have opportunities to talk to our G7 counterparts, a whole range of allies while we're here, a whole range of countries while we're here, to talk about both the concerns we have about the economic spillovers from Russia's war, but also how we marshal support for Ukraine. So I think that's another one. And just broadly, though, whenever you have all these policymakers in one place, you want to make sure you're thinking through, are we doing the things we need to do to support global growth? Are we doing the thing, we feel like we're trying to take steps in the United States to drive growth that we think has been helpful for driving global growth? But are we all collectively doing the things we need to do that? And so I think those are some of the big buckets of things we're thinking about.
And one thing that you've talked about in the past, and I know that's important to you, is the fact that money is actually flowing out of low-income countries, many low-income countries. Could you talk a little bit about that?
Yeah. So, when I talk about the international system writ large providing what we need for these countries, I think to me, as an economist, one of the things you just say is a country that is low on capital relative to the world and has a potential growth rate faster than the rest of the world
should get more capital.
That's where the money should be going. Now, obviously, that's not going to happen for every country, right? There are going to be times where a country doesn't have the right policy framework in place, has risks that keep the capital from coming in. But in particular for countries that are working with the fund or working with the bank really productively, have sound macro frameworks in place, and have these kind of really pressing investment needs in terms of both development and climate, that's something we've got to make sure that the international financial system is getting money towards those countries. And I think if you look, in 22, something like 70 countries had net negative flows from the private sector. That's problematic. I think in 2023, not a single sub-Saharan African country was able to issue bonds. That's kind of a warning sign. And just writ large, a large chunk of countries were actually seeing net negative flows over the last year or two. And that's something that we don't see as viable. the IMF and the bank and the World Bank and the other MDBs really did step up. Since the pandemic, a huge chunk of the flows that are going to these countries have been the IFIs stepping up. But what we need is to make sure the system as a whole, whether it's the bilaterals, the private sector, and the IFIs, are channeling money towards these countries in the right way. Because if not, we're just going to have years of missed opportunity in terms of both climate investments and more broadly development investments.
What's your assessment of why this is happening and what could be done to sort of reverse it?
So some of it, I think, is certainly, pandemic scrambles a lot of things.
Richer countries have more ability to use the fiscal lever.
Yeah, and so I think there are a bunch of concerns, and that's why it's not surprising that it was IFI money, especially in 2020, 2021. But I think it's a question of, we have built up a really powerful toolkit over the last, number of years, but especially recently we've strengthened that toolkit. And I think if you look at what has happened through both the MDB evolution process, or more specifically kind of implementing the CAF report recommendations to really stretch the MDB balance sheets in ways that I think, at this point, we think over $200 billion over 10 years of headroom has been expanded in the system, and there's more space there. That's a lot more lending firepower there. The IMF, obviously, we've just as a group pushed through a quota increase, but more importantly for lending directly is all the money that has gone to the RST on the one hand and the PRGT on the other. The U.S. is very, very, very happy that at this point Congress has given us authorization to lend up to $21 billion to the PRGT, so to make sure it has the resources to lend to low-income countries at concessional rates. And so our view is there are a lot of tools in the system within the IFIs. That's one set of tools. We can also use some of these tools, I think, in particular, whether it's credit enhancements or other tools the MDBs can use to pull in private sector funds, whether it's originate to distribute type models that places like IDB Invest are pushing on, other creative steps the bank and others are taking, try to pull in private capital to try to reverse that net negative flow is important. I also think, though, the bilaterals need to be very aware of what they're doing. And I think, when a country is starting a new fund program and there needs to be some financing assurances, we need to make sure the bilateral creditors are stepping in. If the country's solvent, it's just illiquid, that doesn't mean taking big haircuts. That just means reprofiling, doing what kind of historically the Paris Club lenders always did very quickly and just say, okay, we're not taking losses here, but we need to reprofile and stretch the way the money is flowing for this country. But also, I think if you look at what a lot of creditors, the US in particular, but many others did after the 80s and 90s, is say, for some of these low-income countries, maybe grants make more sense than loans in some of these scenarios. I was saying earlier, when I gave this speech last week, sometimes, if you write a speech, you sometimes leave a blank for a fact that you don't know what the fact is, but you're curious. And you say, all right, how much grant money has gone from the U.S. to sub-Saharan Africa relative to their net financing from debt flows? And I didn't know what the number was. I had hopes for what the number was, but it frankly surprised me what it was, is that the U.S. gave, in grant form, $70 billion to sub-Saharan Africa over a 5-year period, when the entirety from all sources of net debt flows was $130 billion. Right? Had the U.S. done that as loans instead of grants, it would have been far and away the largest creditor to these countries, and they would have been in deeper debt. Right? And so I think for more countries that have been emerging creditors over time to start saying, you know what, there are some countries we should probably be doing more grants than loans, I think is another really helpful thing that we could be encouraging. At a minimum, though, reprofiling loans when it looks at all necessary, doing it quickly, not necessarily taking losses, but doing it in a way that helps that country not face some sort of big wall of payments.
Let's dive down a little bit in that quickly category, because that's been one of the problems, that this process of restructuring loans seems to be very, very dragged out. And while that's taking place, it's very hard for these countries to make progress. I think any ideas, initiatives about how to, speed things up?
I think there are two things you can think of. One is in the cases where it's not a solvency crisis, but it's just the fund says we need some financing assurances, that should be easier and should be quicker, because you're not talking about haircuts and negotiating comparability of treatment and all that. You're just saying, reprofile in a net present value neutral way. That should be faster and easier. On the question of when you are looking at restructuring and debt treatments, that is admittedly more complicated, and every case is different, and every particular loan contract is different. I think there are a few things. I think honestly, I think the fund and the bank deserve a lot of credit for forming the Global Sovereign Debt Roundtable. I think that's been a really, really constructive thing. The fact that you have private sector lenders, borrowing countries, and creditor countries at the same table. I've been at a lot of these meetings, and when a country that is going through a restructuring is sitting there saying, this is what it's doing to the people of my country that the rest of you can't get to yes quickly. This is what it means on the ground. That's compelling. And there are times, the US will try to portray that message in some meetings and say, hey, we need to help these countries quickly. But we are not the perfect messenger relative to the finance minister of the country in question saying, this is what it's doing to my people right now. And I think that's been helpful, but it's also brought the different players together at times in very technical working groups to say, okay, let's talk comparability of treatment in a debt treatment. What does it mean? How do we think about timelines? How do we think about specific things? And then hearing from the other creditors, trying to work with China both bilaterally, but in these multilateral settings to say, what is it you need? What's slowing things down? What information are you not getting quick enough? And I think that's been one feedback from both the private sector and some bilaterals of like, hey,
so you need more transparency.
Can we get more information faster? Because it does take us some time to get to yes. The earlier we get the information, the faster we can get to yes. So I think there are a bunch of steps we're trying to take. I know people have noticed that we have made progress steadily more quickly on some of these country cases. And I think now the goal is to take what we've learned from that and try to make it so it's more known that you'll get to yes quicker, so that a country debating, do I go into the common framework or not, has a little more certainty of what that involves.
That the prospects are better.
That the process can work.
Yeah. Let's switch to IDA. So IDA plays a very important role in providing concessional finance to these poor countries, and it has to be replenished every 3 years. So how is the US Treasury thinking about IDA, both in terms of funding and also in terms of how it's used from a policy perspective?
I think we are big supporters of IDA. We think a very strong replenishment is absolutely necessary. I think we also, though, in this replenishment round are hoping to really drive attention not just towards headline numbers, but towards impact, and try to make sure the funds coming out of IDA, that IDA is using its balance sheet as well as possible. So it's not just how much money flows in, but how much lending and grant money that can mean towards these countries, and on what terms and in what way. But also the governance reforms around it, the efficiency reforms around it. How can we make sure that what's taking place at the bank is happening fast and efficiently and in an agile way? And I think this is not something we're yelling into the wind about. I mean, this is something the bank itself is trying to take steps on as well. Ajay Banga has been really productive in this place, but really a lot of folks at the bank have been working very hard on this. And so I think our view there is we need to take this opportunity of an IDA replenishment, both to make sure the funds are there and make sure they can have as much impact as possible.
It makes sense if you can make it process more efficient, so you can increase the throughput.
Exactly.
Talk a little bit more about the notion of originate, distribute. You mentioned that very briefly. What do you have in mind?
So this is something I think IDB Invest, which is the private sector arm of the IDB, has been looking into how they can do this more. I think one thing that we're trying to look at here is, frankly, not all innovations have to happen at the bank. Many of them do, or at the World Bank. Many of them, though, can happen across the system, and the system can learn, different parts of the system can learn from each other. I think IDB Invest is this kind of private sector arm of the IDB, is a place where they're trying to figure out how do we make loans that then, once a project is established and has a funding flow off it, we don't need it taking up place on our balance sheet. This is now, maybe the private sector wouldn't have come in when there was more uncertainty, But now that the project is up and running and there's a flow, that's something you can sell.
So when it goes from negative cash flow to positive cash flow.
And then you can flip that to the private sector, reopen the space on your balance sheet, and go back and do more good with the space you have in your balance sheet. So I think that's the kind of, I think there are a number of creative ways around these types of tools where what we're hoping is to continue to encourage innovation in the system, whether it's at the bank or other places, to try to make sure we're pulling in the private sector wherever we can, because I think all of us view both, whether it's climate needs or sustainable development more broadly needs, there's no way that there's enough money just in the big institutions to solve that problem. You need both domestic resource mobilization, like you need money from the countries themselves to make some of the funding sources more durable, but you need private capital, and you need a lot of it, and you need to find ways to make sure it can flow places.
So let's talk about that for a moment.
Yeah.
How do you crowd in more private capital? I think everyone agrees that you need a lot more private money, but figuring out how to create the mechanisms to do that. What are your thoughts on that?
So first, I'd say it's not simple. I think there are sometimes we'll talk to, or not to pick on anyone in particular, but I have seen people in the private sector who will sometimes basically have the idea, well, hey, if the public sector would just take all the risk, we'll bring in lots of money.
Yeah, we like that, right?
Yeah, and we're like, I'm not sure that's actually going to be the model that works. So we can't just have that vision of it, but I think there are cases where the MDBs do have tools. I think we talked about before that, if you look at the use of guarantees as an example where the bank is trying to do a lot right now to make sure there's a single guarantee platform instead of it being spread out across different units of the bank, because that'd be more efficient for investors that are trying to look at these tools, make it easier for, frankly, just for staff who are working on a country to say, oh, these are tools I could use, not just balance sheet related tools. So I think there are some interesting, just real kind of doing the hard work of procedures and institutional changes that make these tools more effective and better used. Some of it could be these more kind of innovate to distribute type models. I think there's a lot the MDBs can do. I think, from the IMF perspective, I think one of the most important things it can do is make sure that when the fund is going into a country and the markets see that the fund has gone into a country, what you want is if the IMF is there and there's a staff level agreement and it's moving towards the board, everybody else says, oh, this country must have good policies now. There's no way the fund would be there if they didn't. We know this is a case where things are going to be headed in a better trajectory. And that should be, when the fund comes in, that should crowd in private sector capital. What you really need to make sure is that the fund is, that signal is clear. That if you see the fund, you say, oh, I know they are rigorous, I know they are disciplined, I know they wouldn't be there if the country wasn't doing all the right things. And so this means this is a place I should be looking for investment opportunities.
Yeah, and presumably the fund can get a much better deep analysis than any private sector actor could do. So they can do things that the private sector can't accomplish.
The teams here will always have more knowledge. The teams at the fund will always have more knowledge than any given private sector investor is going to. And so trying to make sure that signal is clear and that the private sector crowds in after the fund. I think, and not just private sector, sometimes bilaterals too. And I think of recently, you could take an example of, I think the fund really wanted to make sure that before it reached the next phase of a staff level agreement with Egypt, that all the reforms were in place. And I think what you saw is then that did help actually kind of UAE money flowing in right away, saying, oh, okay, like the reforms are there. We know the fund wouldn't be saying yes if the reforms weren't in place. Mm-hmm. And I think that helped motivate money to come in. I think that's kind of the goal, is to have more of that.
So let's talk a little bit about the World Bank and the other multilateral development banks. How do you, the world has changed pretty dramatically over the last 80 years. And the challenges of the global commons have become, I think, much more significant. I mean, climate is obviously an existential problem. How do you assess the World Bank and the MDBs in terms of those global public goods problems, in terms of their ability to help tackle them effectively? Are you happy where we are, or is there more that needs to be done in terms of evolution?
I'd say we're very happy on the trajectory we're on. I'd say that, I think it's now.
I mean, Treasury Secretary Yellen, really sort of pushed the ball forward.
Yeah, about 18 months ago, she gave a speech that had, talked about MDB. She had mentioned it earlier. Lots of people have been discussing this for a while. She gave a speech that tried to really get more specific on what you could hope to do. And I would say we have seen real meaningful change. I think you can look at just the mission statement overall at the World Bank has changed out of this process. I think really putting global challenges on the map of saying, look, climate, global public health, pandemic preparedness, and other challenges, and conflict and fragility. That these are three things that I think the way we have sometimes thought of it is, look, when a country makes investments in these areas, the benefits from the investment they're making.
There's big externalities.
Yeah, exactly. It's an externality story, and that means the global system has to be helping them. This is not kind of the old world of, hey, there's a project that's going to pay off entirely within your country. Right. And so I think that notion that we really need to make sure we are marshaling more of our resources towards these goals, because if left to their own devices, countries are naturally going to underinvest in these things that have externalities. I think you see it from even the really simple statement of purpose for the bank now, ending poverty on a livable planet. Right? I think that pulls together a lot of these themes into one place. And so I think we're very happy with where we're seeing there. I think, as I mentioned before, part of this evolution process is also then, if you're saying you're broadening the mandate in some ways, or not even just broadening, but saying you can't end poverty without addressing these things. These things, even in a well-managed economy that is doing everything right, some combination of climate, pandemics, and fragility and conflict can derail all your development gains in a heartbeat. And so we need to solve the problems we've been trying to solve on poverty and sustainable development. We need to be addressing these other things, or we'll just never get where we want to get. So I think we understanding that, then that means, though, also we need more money in the system. And I think that's where trying to figure out how do we stretch the balance sheets responsibly? How do we make sure we are driving towards that? And I think there's been real progress there. And I think the hope is to continue the progress. And then I would say kind of in between, if you think if there's like mission here and there's money here, then there's like how do you do it is really important. And I will admit, when we talk to the media, or when we try to explain to anyone, often those are the two things that are really easy to explain. And then you try to get to, it's like, here's how we're going to change incentives for staff, and here's how we're going to change operational procedures. People's eyes sometimes do glaze over a little, but that's incredibly important work. And I think really we've been trying to see huge work happen at the bank and at the other MDBs, increasingly trying to drive in those directions. I think it's the whole notion of MDB evolution as opposed to kind of a one-shot revolution was, this isn't something you do in a day. This is something that you continue to make improvements on. I think the kind of 6-month calendar of bank fund meetings is actually very useful in this regards, right? It's like, okay.
Enough time, that capacity to sort of see if you've made some progress.
Let's make some progress every time. I think when we, coming back a year ago, October, say, okay, let's make sure by the spring meetings, there's actually stuff on the table. Let's go harvest the low-hanging fruit. That's not everything, but let's make sure there are actually things we've accomplished. And then it's like, okay, you do those things. And at the same time, you say, okay, great, what can we do by the next 6 months and the next 6 months? And to keep that process rolling, because I think there's always going to be more we can do to try to make these institutions who are so crucial to all the important goals people have, make sure they're as effective as possible.
Same question for the IMF. We're in the IMF building.
Yeah. Look, I view the IMF as just, it is the unique institution in the world in one respect, right? No one else can bring money and rigorous policy advice together in the way the fund does. And that makes it the indispensable organization as part of the global financial safety net. No one else plays its role. And so I think part of that is to make sure it has the resources to do it. That's why, the U.S. is, really was a big believer in restoring it to a more of a quota-based institution, getting a 50% quota increase through, which we thought was really important, and appreciated all the work we could do with partners and allies in all countries and with the MD and the staff to try to get to that position, and now it's incumbent on all the countries to actually get that through their own legislative processes. So that's important. Making sure there are enough resources in the PRGT and RST, I think, incredibly important. The PRGT, I think, we've done a lot on the loan resources. It's really important to make sure the subsidy account is there. One of the things the U.S. Has been supportive of is trying to make sure we're using kind of internally generated resources, future lending income. Once the precautionary balances look like they're in good places, that means there's some money that could be redirected by the members over towards the subsidy account to make sure we have enough money to do the things we need to do for the lowest income countries in the world. But then part of it's just rigor. And the fund, as we just said, the fund knows these countries better than anyone. Going in and making sure that fund, when the fund says yes, everybody knows that's a really important signal. That's just always crucial.
We have like 20 seconds left, so I'm going to ask you a really hard question.
Okay.
The higher level of interest rates, does that make it more difficult to do all these things? Because we lived for a long time with interest rates that were rock bottom.
Yeah.
And now we have sort of interest rates that are sort of more typical of the last 40, 50 years. How do you think that plays into all this?
It plays into a bunch of things. I think even just as you stay where we just were, the PRGT subsidy account, it's more expensive when the gap between zero and the SDRI is bigger. That requires more resources. It means more countries are looking for concessionality in more places because the market looks more challenging to them. So I think those are certainly challenges that we have to navigate. It means countries have debt coming due, and what's available on the market may not be on the same terms that they're rolling out of. The rollover gets more expensive, which can make the kind of liquidity challenge countries are facing more pressing. So I think what it does is just tell us that we have this great toolkit. We need to use it more effectively in a situation like that.
Okay. Well, we're out of time, I think. So thank you so much.
Thank you. Thanks.